Have you ever approved a decision, only to later discover it cost the company hundreds of millions? You're not alone. Thousands of managers are leading teams, running projects, and building strategies, all while being financially blind. They believe that simply sensing the market is enough, and let the accounting department handle the rest. But the truth is, you can't control what you don't understand. Every number in a report tells a story about profit, risk, and the very survival of the business. If you can't read it, you're driving through fog. Finance isn't just a tool, it's the radar behind every smart business decision. So how can you understand and use finance effectively, even if you're not an accountant? There's a practical, simple, and highly effective approach. Part 1. Practical financial thinking. Most financial training programs fail because they start with concepts before showing results. Workers don't look for definitions of current assets. They want to know, how much value do I create per hour of work? The core problem is a lack of connection between finance and individual roles. When people don't see themselves in the numbers, they lose interest in the balance sheet. What organizations need is to change the starting point from textbook to real experience. Finance must answer the question, does what I do matter? A common mistake is applying the same financial content to all levels of staff. In reality, frontline operators only need to understand a few metrics that affect their performance and income, not the entire accounting system. When they don't know which numbers truly matter, they either ignore them, misinterpret them, or lose motivation. Worse, they work without knowing where the financial results go. That disconnect between behavior and performance quietly destroys productivity. To change this, financial goals must be simplified into numbers that are easy to measure, easy to understand, and repeated often. For example, every employee should know exactly how much value they generate per hour. Once this metric is transparent, motivation naturally follows. No need to teach accounting, just measure the right results. And this doesn't start with the finance team, but with team leads and project managers. They are the ones who translate financial language into specific work. The operating system will change once the mindset of measurement changes. The fastest way to financialize an organization is to select one key metric for each position, then embed it into weekly reports, morning meetings, and regular reward systems. Don't let it sit in an accounting spreadsheet. It should be printed on boards, posted in workshops, mentioned in meetings. When employees start talking about value per hour as a habit, you've succeeded. It's no longer about teaching finance. It's about turning finance into behavior. And when behavior changes, the entire organization's performance will rise. Part 2. The art of finance. Many people think finance is an exact science, but in reality, it's full of assumptions, judgments, and personal choices. Every report is a mix of objective data and subjective interpretation. Profit isn't always a hard number. It's the result of multiple decisions over how many years to depreciate, how to value inventory, when to recognize revenue. These factors make finance the art of adjusting reality. Looking at the number is not enough. You must understand how the number was created. The biggest danger doesn't lie in errors, but in making decisions based on the illusion of accuracy. When leaders treat reports as absolute truth without understanding the data's foundation, the organization can drift off course. Wrong assumptions lead to wrong strategies. Beautified reports are not uncommon, not out of fraud, but from choosing favorable perspectives. This leads leadership to be guided by a different version of reality. When this happens repeatedly, strategic misalignment accumulates. Critical thinking must be part of every financial meeting. Instead of asking, what are the results? Start with, how were these results built? This is not about assigning blame, it's about revealing the assumptions beneath. Organizations need open discussions on how numbers are calculated, estimated, allocated. The more transparent the number formation, the less likely impulsive decisions will be made. Finance is not just an answer, It's the process of asking the right questions to create a picture that reflects operational truth. An effective step is to create a financial assumption summary for each important report. Every time something is sent to leadership, it should include an explanation of how the numbers were formed, what growth rate was used, which data the forecasts rely on, how wide the risk margin is. When this becomes an organizational standard, everyone sees finance through an evaluative lens, not passively. And when people understand that numbers can shift based on assumptions, that's when real quality control in decision-making begins. Part 3. Distinguishing accounting from finance. Accounting and finance are often lumped together as the numbers people. But in reality, their functions are fundamentally different. Accounting records what has happened, while finance uses that data to guide action. A great accountant may produce perfect reports without contributing to decision-making if they don't understand operational dynamics. Conversely, a finance professional can't design sound strategies if accounting data is inaccurate or inconsistent. These two functions are inseparable. Many organizations operate with accounting data that hasn't been rigorously verified, yet they still use it to build budgets, forecasts, or make investment decisions. When the foundation is unreliable, all analysis built upon it becomes systematically flawed. That's why strategies that sound reasonable often fail repeatedly. The problem isn't lack of talent, it's that people are using the wrong map. If accounting errors are found too late, the damage is already done. The issue isn't in the forms, but in the linkage between the two systems. To fix this, organizations must establish regular cross-check mechanisms between departments. Every major financial decision must be accompanied by confirmation of the reliability of the input data. This isn't about control, it's to ensure that the strategist is using true colors, not tinted ones. When verification becomes an organizational habit, decision-making quality will skyrocket. Turn accounting reports into the foundation, not just a submission form. The right map is the prerequisite for the right direction. Part 4. Financial transparency and psychological ownership. One of the most powerful levers for boosting internal performance doesn't lie in tools, but in the sense of ownership. When workers understand the company's financial situation, they no longer work just to complete tasks, they begin to act as if they're running the organization themselves. This sparks proactive behavior, resourcefulness, and cost optimization. The issue is, in many organizations, finance is kept secret, like a restricted zone. The result is that workers can't see the consequences or the rewards of their actions. Lack of financial transparency doesn't just reduce trust. It creates the mindset of, I do the work. Profit and loss are the company's concern. In this environment, performance isn't driven by collective results but tied to job descriptions. Separating finance from operations removes the most powerful tool to activate internal responsibility. Successful organizations are those where everyone can see whether the game is being won or lost, not through thick reports, but through metrics anyone can understand. Instead of sharing everything, the right approach is to identify a few numbers that represent financial health and tie them to employees' daily context. For example, profit per labor hour, profitability ratio, or net cash flow. When these indicators become part of internal language, behavior shifts naturally. Operators don't need to be finance experts, but they do need to recognize danger thresholds and green light signals. At that point, efficiency comes from insight, not just instructions. To do this, first build a simple visual financial dashboard that updates weekly or by project. Avoid complex terms or charts. Use monochrome graphics, progress trackers, or color-coded indicators. Every team needs to see, are we in the green zone or red zone? When numbers come alive, behaviors turn proactive. Financial reports only have value when they reach the people generating the results. Operationally, start by publicizing the 3 most important financial indicators company-wide, updating them regularly, and linking them to clear reward and penalty systems. Monday meetings should not only cover tasks, but also numbers, from factory floor to office desk. Everyone must be reminded, today's performance determines the end-of-quarter results. When that becomes part of the culture, something magical happens. Workers think like owners, act like investors. That's when the organization enters a true trajectory of endogenous growth. Part 5. Specialization with understanding the rules of the game. Modern organizational models are built on specialization, which increases efficiency and reduces overlap. But specialization also has a dark side. Workers know how to do their jobs, but not why. They're skilled at executing processes, but unaware of the organization's ultimate goals. When finance is seen as someone else's responsibility, the whole operational machine plays a game without knowing the score. This weakens responsiveness, blurs long-term direction, and kills intrinsic motivation. A clear sign of this is the blame game when business results decline. Technicians blame weak marketing. Sales blames outdated products. No one stands in the middle to connect end results with initial behavior. Because people don't understand the scorekeeping system, the financial system, each individual optimizes their own task, but the organization still loses. If everyone understood the critical metrics, the entire system would align around a shared financial target. There's no need to turn every employee into a multi-skilled expert. What's essential is helping them see that every position influences cash flow, profit, and company value. Even in nonprofits, survival depends on bringing in more than is spent. Basic financial literacy must be embedded in cultural orientation and onboarding training. Each individual must know they're part of a specific financial system where every action has a convertible value, and every decision earns a measurable score. Part 6. Choosing core financial metrics. Finance is full of metrics, but the key isn't knowing many, it's choosing the right ones. Every business should clearly define 1 to 3 core financial indicators suited to its industry and goals. Not every organization needs to track return on total assets or the cash conversion cycle. Some should focus on profit per labor hour, others on operating cost ratio. When metrics are tailored to the business model, they don't just measure, they guide action across the organization. A common issue today is that every department drowns in spreadsheets but has no clear sense of purpose. When all metrics are presented at once, none get prioritized. This leads staff into reactive, unfocused behavior. A dashboard with 30 metrics can overwhelm more than help. Each department should own one key metric they can control and improve, and the organization must ensure that metric is repeated frequently across all operational channels. Effectiveness comes when metrics are tied to daily practice. No one remembers complex financial concepts, but everyone understands how much value I create per hour. That simplicity drives behavior change. The closer a metric is to daily action, the more it creates internal motivation. To achieve that, managers must work with their teams to identify what truly reflects the quality of their work. When employees believe they are being measured fairly, they will strive in the right direction and results will be sustainable. Selecting financial metrics shouldn't stop at reporting. They must be present in weekly meetings, visible on internal boards, and referenced in performance reviews. When metrics become part of the operational rhythm, teams no longer wait for top-down supervision. They self-monitor, self-correct, and self-drive improvement. That's when finance transcends measurement and becomes a tool to build a performance culture. Each correctly chosen number becomes a lever for ownership and growth. Part 7. Profit versus cash flow, a critical difference. Many businesses fall into the illusion of growth when profits rise while real cash is running out. Profit is an accounting concept, built on accruals and allocation assumptions. In contrast, cash flow shows the real survival status: is there money or not in the account. A company can show big profits on paper and still go bankrupt because it can't pay wages. This is not an exception. It's the most common trap that lures many managers into financial delusion. This stems from 3 frequent mismatches. First, revenue is recorded when goods are delivered or services rendered, but the cash hasn't arrived. Second, major investments like machinery don't reduce profit immediately, but drain cash in the same period. Third, costs are recorded when incurred. not when paid, causing real cash flow to misalign with reports combined. These three discrepancies can paint a dreamy profit picture while the business teeters on the edge of liquidity crisis. Leadership thinking must shift from how much profit to what's the cash flow. Reading financial reports must go hand in hand with reviewing the cash flow statement. It's non-negotiable. Leaders must be trained to recognize the gap between profit and cash, and to treat cash flow as the primary survival metric. In volatile economies, cash is not just a weapon, it's armor. The organization that controls cash flow controls its capacity to weather risk. In practice, every investment or expansion decision should be tested with a cash flow scenario. Before launching any project, simulate monthly cash flow to see whether the organization has enough financial strength to survive the initial phase. At the same time, embed cash flow into the KPI system so staff pay attention not only to revenue and profit, but to when cash actually arrives. When every operational decision asks, will this help improve real cash flow, the organization becomes cautious, yet effectively growth-driven. Part 8. Financial transparency, a crisis shield. Financial transparency isn't just an ethical requirement, it's a survival strategy to avoid organizational crises. When cash dries up, revenue drops, or markets shift, the one thing that holds a company together is internal trust. And trust cannot exist when people are kept in the dark. When employees understand the financial situation, they adjust behavior positively. But if excluded, they feel detached, leading to apathy, doubt, or even resistance. Lack of transparency creates an invisible wall between leadership and operations. When employees only see end-of-month announcements and don't know what happened beforehand, they can't empathize with the strategy nor help with solutions. Many crises don't stem from finance, but from poor internal communication. Numbers hidden for fear of causing worry often spark more chaos, because nothing is more frightening than not knowing what's going on. To build a resilient operating system, organizations must create mechanisms to regularly disclose key financial indicators. No need to share everything, but enough so that everyone sees the financial health status. Short updates, clear visuals, and simple messaging help unite the team. When employees know where they are on the financial map, they act to overcome challenges. And when they share the reality, they will help find the way out together. When finance is limited to only those who understand it, the rest of the organization is forced to play a game without knowing how scoring works. Why talk about growth if you don't know how much money is left? Who truly controls the outcome, the one holding the balance sheet, or the one creating the cash flow? If numbers are the language of power, are those who don't speak it being excluded from the game? And if transparency is risky, is secrecy truly safe? An organization is only truly strong when everyone knows what they are playing for. Thank you for watching the whole video. Please like and subscribe to the channel so you don't miss the next videos.